Imagine you are starting a year-long project, like building a house. You need a large sum of money to complete it, but you only need a fraction of that cash today to pour the concrete. If you take out a traditional personal loan to fund this construction, the bank doesn't give you the money in phases. They drop the entire approved lump sum into your account on day one. And here is the immediate trap. This diagram illustrates your loan balance. The moment that money hits your account, the interest clock starts ticking on every single rupee. Even though you're only using a tiny sliver of active cash for your foundation, you are paying interest on a massive pile of idle cash, just sitting there waiting for the roofers 6 months from now. For decades, anyone with a staged project or unpredictable cash flow just absorbed this massive drain on their wealth as a standard cost of doing business. Traditional loans are rigid by design. They guarantee the bank a predictable monthly return, leaving you entirely responsible for the inefficiency of holding capital you aren't ready to use. But there is a different mechanism, engineered specifically to handle variable cash flows. It's called a Flexi Hybrid Loan. Instead of handing you a lump sum, the bank approves you for a maximum credit limit. You withdraw cash from that limit exactly when you need it, and you only pay interest on the precise amount you actually withdrawn. You stop paying for the privilege of holding idle money. Debt becomes a utility. You only pay for the exact liquidity you consume. Let's look at exactly how this works. This animated diagram shows a case study where you are approved for a 20 lakh Flexi Hybrid limit over a 7-year term. For the first 2 years, you enter an interest-only phase. Right now, your wallet on the left is empty, the bank limit on the right is untouched, and the interest calculator is sitting at 0. Your project begins, so you withdraw half your funds. Watch as 10 lakh rupees moves into your wallet. The interest calculator turns on, but notice that it is strictly tracking that active 10 lakh rupees. The remaining 10 lakh rupees limit stays untouched, costing you absolutely nothing. During these first 2 years, your monthly out-of-pocket cost stays incredibly low. You are not required to pay back any of the principal yet, only the interest generated by your active balance. Now, suppose you finish a phase of your project under budget, or you receive an unexpected surplus of cash. You take that money and send 3 lakh rupees back to the loan. The interest calculator instantly recognizes the return and drops its base to 7 lakh rupees. There are no hidden fees, no bank approvals required to make this deposit, and 0 prepayment penalties. The transaction is entirely frictionless. A month later, a new expense pops up. Because the facility is active, you can simply pull that 3 lakh rupees right back out into your wallet. The calculator adjusts again, and you didn't have to submit a single piece of new paperwork. The interest-only phase decouples your access to cash from rigid penalty structures, giving you absolute timeline control over your money. Without paying back the principal, revolving credit easily spirals into a permanent debt trap. You could pay interest forever without ever clearing the loan. To prevent this, banks engineer an automated safeguard called the drop line phase. This chart tracks your 20 lakh rupee limit over time. Watch what happens exactly at the year 3 mark. The maximum limit begins to drop, angling steadily downward towards 0 over the final years of the loan. The total available credit shrinks every single month. Eventually, that descending ceiling intersects your actual outstanding balance. When that collision happens, your payment structure shifts from interest-only into a regular fixed EMI, forcing you to pay down the core debt. If the limit is dropping, but your wallet is empty, and you haven't withdrawn any funds, the cost to you remains exactly 0. The drop line operates as a brilliant hybrid mechanism. It enforces long-term financial discipline, ensuring the debt is cleared, while entirely preserving your short-term liquidity. This comparison matrix highlights the stark differences in these financial models. Traditional loans give you fixed blocks of debt, full lump sum payouts, and charge interest on the entire amount. Flexi Hybrid loans give you dynamic, fluctuating blocks, withdraw as needed limits, and charge fractional interest strictly on what you use. That frictionless access to capital comes with a very clear danger. Managing a massive line of active credit requires immense self-control. Borrowers lacking discipline might easily overspend their limit on non-essential purchases. By maximizing their debt early on, they set themselves up for a severe financial shock when that drop-line phase eventually triggers and forces heavy principal repayments. A Flexi Hybrid loan does not fix bad financial habits. It acts as an amplifier, rewarding disciplined borrowers with massive interest savings and punishing impulsive borrowers with maximized, unmanageable debt. The Flexi Hybrid structure belongs to a broader transition toward usage-based models and on-demand transmission. Software once required large upfront fees for tools used occasionally. Today, cloud computing charges you by the second for the exact processing power you consume. This credit model applies that same utility logic to capital, turning debt into a metered resource. As income streams and project expenses become more variable, the practice of tying interest on idle cash becomes an unnecessary tax on your capital. Efficient borrowing now depends on syncing your debt directly to your immediate needs.